Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Jennifer Schnabl, Vice President of ETF Capital Markets Group at State Street Global Advisors. We're going to take a look at the key themes impacting fixed income investors. Jennifer, it's great to have you with us. Welcome to Trade Talks.
Thanks so much. Great to be here, Jill.
And we all know the FOMC raised rates for the first time in a number of years just yesterday and set the path forward for 6 more hikes this year. How has the landscape for bonds changed in the last year, and how should investors consider positioning their bond portfolios against this backdrop of rising rates?
Well, it's a great question, Jill. It's certainly not an easy time for investors as a whole right now, but I would say specifically fixed income investors. You've had a tremendous amount of rate volatility since the start of the year, even in the end of last year, and obviously peak inflation print, CPI coming in at 7.9% year on year, the last print, a 40-year high. None of these things has served bond portfolios well. The rising rate narrative, which, as you mentioned, Chair Powell now is formalizing, and we can properly say we are entering a tightening cycle and expecting 6 more rate hikes probably before year end. Where does this have bond portfolios shaking out? So year to date, just to give you a sense, the Bloomberg Ag is down 5.5% year to date. IG investment grade as a whole, which has a longer duration, is down 10%. High yield is down roughly 6%, depending on which benchmark you look at. None of these things look great or feel rosy. It's just a lot of red. So what does a bond portfolio manager do? How do you sort of navigate the fixed income space if you are at the helm of one of these portfolios? Well, not every fixed income instrument was created equal. And the prevailing theme that we are seeing is, generally speaking, a rotation out of fixed rate debt and into floating rate notes, namely bank loans. So just as a reminder, floating rate notes allows the investor to earn a coupon or income, I should say, that is connected or tied to the prevailing market interest rate. So the sentiment shift of, if you want to call it float with the Fed, that's kind of caught on as a bit of a term, a catchy term, but getting out of your extended duration fixed rate asset and just moving into something where you can monetize on rate hikes as they come, and as we are now sort of going to the picture that we're going to enter into. SRLN, which is our the largest loan fund ETF in the world. It is our bank loan ETF, saw a tremendous amount of inflows in 2021, 6.8 billion. It stands at 9.5 billion assets under management currently. And even during the volatile start to the year, it's already gathered 900 million in net new inflows. I think with the FOMC yesterday and the rate hikes actually officially starting, we will just continue to see conviction into this trade.
And in light of this underperformance we've seen across most fixed income asset classes this year, how should investors be navigating these fixed income asset classes? Is it just a game of choosing the best of the worst performing?
Yeah, exactly. So a little bit this, like, everything's in the red, and do you just pick the best of the worst? Well, I think it's important to take a step back and maybe remind everybody. I feel like the conversations we're having with our investors revolve around this as well. Just remind ourselves, what is the role that bonds were meant to play in our portfolio? So taking it back to the classroom almost, bonds were meant to provide diversification against equities. They were meant to provide capital preservation. So barring defaults, one can assume that they might get their principal back should they hold a bond to maturity, and income generation in the form of coupons. Well, these 3 things still hold true, and they hold true, I would say, almost especially in times of pain or uncertainty, which is perhaps what we are going through right now. Now, we are seeing people being more tactical within the fixed income space. So moving out of the long end of the curve, these extended duration fixed rate assets, and targeting the short end of the yield curve. So we have another fixed income ETF, BIL. It is a 0 to 3 month T-bill ETF. And that has seen a tremendous popularity in the last few months. It gathered $1 billion of net new assets in the month of January on the back of this sentiment. If it also doubles as a place to park your cash for those that just kind of want to wait on the sidelines with all of the uncertainty we're experiencing in the markets, geopolitical uncertainty, COVID variants still roaming around. It's a safe investment, obviously, with T-bills being backed by the government, but the coupon similar to the float with the Fed, it's tied to the prevailing market interest rate. So again, allows investors to monetize on the situation when central banks do hike rates.
You know, it's a great point that you bring up, Jennifer, about reminding ourselves as investors with the role that bonds do play in the portfolio. I'm glad that you brought that up. And there has also been tremendous growth in bond ETFs over the last year. And you've mentioned a few already. What other trends are you monitoring at State Street as it relates to investor preference and position?
Right. So no, I mean it's a great question. We have seen a tremendous interest, a sort of increase in interest, I should say, in the actively managed fixed income ETF space. Just in the last few years, the loan ETF I mentioned earlier, SRLN, is actively managed by Blackstone Credit, which they are the largest loan fund manager in the world, and that their outperformance, the outperformance of that fund, I think is due to that actively managed, the active managed nature of that fund. We just launched another actively managed fixed income ETF, HYBL, a month ago, also managed by the same team. And that was born out of investor demand. Investors just have become more and more thirsty and hungry for funds that are run by best in class experts that they can just lean into and sort of, I don't want to say give up the reins or hand over the reins, but effectively that's more or less what it is for these generalist investors who don't have the expertise or institutions that don't have the resources, perhaps the wherewithal to comb through individual bonds or loans or have an opinion on specific line items. This is a really popular way to express their view, gain exposure to multiple asset classes while letting world-class advisors sort of steer the ship. In the case of HYBL, this is an innovative product that holds bank loans, high yield bonds, and a small allocation to CLOs as well. So again, this product will allow an investor to achieve exposure to multiple asset classes below the investment grade line. So it's going to be yieldier than that. But again, let someone else, and arguably one of the best portfolio managers in the world in those asset classes, make the decisions around asset allocations, fixed to floating ratios, things like that.
All right, Jennifer, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.